Hey, everybody, welcome to our CPI Hot Zone session. We did a session like this last week when we covered non-farm payroll. So what we're going to do in this session and this conversation is going to be all about the intraday volatility of a significant high heat hot zone. In other words, we have a scheduled event that is expected to have a high psychological impact, a high volatility impact, and it's going to possibly create some opportunities along the volatility edges. Um, that is what we're going to be talking about here. And of course, we'll be following up with charts and coffee at 9 a.m. like we always do. So we'll be together here for about the next 20 minutes. So if you recall process, right? So if you recall in non-farm payroll, a big part of what we did is just kind of ask ourselves, what kind of risk environment are we inheriting? Now, remember, why is CPI important? Maybe not non-farm payroll-esque important, but why is CPI important? Because in terms of macroeconomic pillars, jobs, growth, and inflation, and those three are going to map forward to the kind of messaging and monetary policy that we're going to get from the FOMC, from the Federal Reserve. So what we want to do is focus on those types of economic events. And when they're really high impact, like we're talking about, bam, you've got a hot zone. So this is hot zone session trading. Higher risk, unbelievably higher risk. So please hear me out. This is not for new day traders. This is not for day traders who are just getting to know their order entry platform. This is definitely something, though, that, you know what, it's almost as if we're sort of extreme testing our ability to see what's happening in the market, and also the indicators that I showcase in both the sessions, in charts and coffee, and in the room sessions. Let me put them through their paces in a live environment. So last week with non-farm payroll, it really couldn't have gone any better. As if the non-farm payroll said, Rag, we know that you're doing this live. Let's just go perfectly into the resistance zone and set up a short. I don't know what's going to happen here. So one of two things. One, you're going to see how I set up a trade and it's going to work pretty well. Two, you're going to see how I manage risk. And either way, you guys win. I may not, but you guys are the way. There'll be something here that should be a really good, positive takeaway. All right. So with that being said, what are we inheriting? A lot of, let me grab my drawing tools here, a lot of a neutral, non-trending environment. Again, I was actually talking to some of the group at the office, and we were discussing some of the tools on my charts and the best way to sort of convey what they tell you when you're looking at them, because I acknowledge there's a lot to interpret here, but we try to use color coding to make it really easy. We have mostly a yellow environment with some short periods of a weak trend. So neutral trend, a little bit of a weak trend. Neutral trend, a little bit of a weak trend. And that's what we call multi-trend that travels across the bottom of that screen. So we're inheriting really a sort of meh kind of morning. Well, unlike non-farm payroll, where I had a decidedly bearish tone, this time we have to look a little bit further into, well, what else can we work with for information? What else can we look at to understand what, if anything, we might get as a trade? Now, remember, please be ready for any session, any morning, any event to yield nothing, a goose egg, nothing. Be absolutely comfortable, pleased, and prepared to be flat. Flat is a position. And for so many traders, that they could just accept that not every move, even if it's volatile and it looks amazing, and other folks are doing the humble brag right on the internet about what a great trade they had. Great. Say, you know what? That was your pitch. Awesome. Wasn't mine, but I will get my pitch. So we might get nothing as well. Another thing I'm going to look at, and this is something that a lot of day traders miss, and that is the insight we can get from the daily. What is the daily telling us? Again, we want to be short. We want to be short in this market. Holy cow. And there is our reaction. We did not get a volatility set up. Nothing. So what's the takeaway here? Oh gosh, look at this move. We'll walk through this here together. This may not be quite as tradable as what we saw last week, but let me show you what we did. And by the way, this is a really good reminder that for those of you wondering, okay, Rog, what did we do last week? We looked at some data before non-farm. We really don't have the same thing in the CPI. Not really. So the daily thing that I'm talking about, and by the way, we've got a webinar coming up in less than a week, 8 p.m. Thursday the 16th. So if you haven't already registered, head on over to simplertrading.com/price. Take a look, gang. This is a lot of bearishness. But remember, gosh, right before it came out, a lot of you are probably pretty already comfortable with some terminology that I use in the rooms called line in the sand, right? Line in the sand. And what that means is there is a sentiment line in terms of psychology that I look at and identify each morning. It has to be done every morning, and it can be done well in advance of the open. By the way, that's going to carry into the open. Most of what I'm going to actually talk about with you all here for this event is, gosh, two things that we've been talking steadily about in the free video. So you don't have to be in any of the services to know what I've been talking about and conveying in our free content over at the Simpler Trading YouTube channel. So first of all, the only direction we had, by the way, intraday, we were neutral. So unlike last week when we inherited this downtrend, he said, look, we're going to look to the short side in front of non-farm. This time I had a very neutral market trend. So then I had to go to the next time frame that I look at, which is that daily, and say, all right, daily, what say you? And daily said, short the market. Not from where we are right now, but that is your bias. Only look for shorts. One of the easiest fixes, when I sit down with day traders who are struggling, one of the easiest fixes, it's one of those fixes where I give them this advice and then I kind of know that they're on the right track. Wow, we're going to take a look at why this is. Notice I haven't even looked at the number, really could care less, but we'll look at it in a moment, just out of curiosity at this point. When we have a chart in front of us where we can see a lack of clarity and the brain says, well, I could be long or I could be short. You have no edge there, right? Unless you're waiting for the market to travel up to resistance and you fade short, or travel down to support and you fade short. For the most part, you shouldn't ever be equally open to either side. There's no edge and a lack of directional bias. So I'll just kind of take a look at some of the other indices here. Same reaction, gang, same reaction. And in terms of line in the sand, your two most bearish indices, it was not the NAS this morning, gang. It was not the NAS, because take a look. The NAS was actually just barely above the line in the sand. So I didn't have a really clear bullish or bearish take on the NAS. We had a much more, and there's a reason I started with the S&P. I had a much clearer line in the sand, because look how close we were trading along that line in the sand, along that psychological level. All right. And then Dow, you can see there's that same line in the sand. So two things here. This is fantastic for the traders that I've been walking through what we want to do with this market, because we have been absolutely, and again, check out the Tuesday and Thursday free videos that I've been sharing with everybody, because you'll say, Rod, you've been telling us to stay short all along. And I'm not one of those folks that says, well, you know, back on this day, I sort of mildly said, no. What have we been saying? And how do you understand why I was short, or why I'm going to continue to look for shorts? Maybe neutral now. What a heck of a rally in May. And what was the conversation? Oh, the bottom's in. Let's buy stocks. Let's buy bonds. Let's buy euro, whatever, right? Because those were the momentum plays. No, gang, just no. Just a big cup of nope, because we respect the trend that was. I'm sure a lot of you've heard me refer to that before. Respect the trend that was. This isn't surprising, gang. This is continuation. And you might say, well, what does this have to do with day trading? Again, you notice this morning, I did not have, like we did with non-farm payroll, a clear directional bias. And let me make sure everyone who's tuning in now, the only thing we had was a bearish directional bias. I did not get any kind of move. I mean, this data just went whoosh, That's it. You remember with non-farm payroll, we had that volatility, right? The volatility is that edge where we had a little bit of a wick, hung out at the resistance, we shorted it, and then it fell. This one just fell right out. And it happens sometimes. So clearly, one of the things we're all curious about, and I still don't know what the data is. That's how unimportant looking at that number is. So let's go take a look. Here we go. All right, CPI. Oh, well, it's no surprise. A lot of you say, Rog, we know we're going down the rabbit hole. Previous was 0.3. Expectations were 0.7. We got 1.0. So you might say, Rog, what does that even mean? What does 0.6, 0.5, 0.6, what does that even mean? So this is a gauge of inflation. This is one of the major macroeconomic pillars. It is the main thorn in the side, pebble in the shoe for the FOMC. And guess what today's data said? It's not cooling off yet. Why did the equity markets sell off? Why have I been saying, please, please, please do not buy bonds, please, because rates are going up. Rates are going up. Notice how bonds sold right off. What does that mean? Gang, Federal Reserve has more work to do in terms of messaging, and the FOMC, the voting members within the Federal Reserve, they have more work to do as far as keeping June half point, July half point. There was some chatter about a hold in September. It was absolutely an incorrect assumption. Bonds played a game of chicken with the Federal Reserve, and the Federal Reserve won. And there's your September number, which continues to climb, showing, yes, we are going to see a rate hike in September. We are very much on our way to pretty much 100% expectation for the rate hike of 50 basis points or a half point in June. By the way, these graphs are the Fed Fund Futures graphs. This is courtesy of the CME, which is such a cool service that they've made available to us traders to understand the probability for where the target rate, the Fed Fund Futures, are indicating where the target rate will be. What does that even mean? What's the Fed going to do? Are they going to hike? Yes. By how much? That's the data we get from here. All right. So back to the charts. That particular release indicates that we are not seeing a leveling off. We are not seeing a cooling off of inflation, and the Federal Reserve still has to do what? Hike rates. Who's going to love it? The US dollar. Who's going to move lower on this data? The euro. We've been talking about staying short the euro. All right. We've been talking about staying short bonds. We've been doing that mostly through IEF. That's been a position in my mastery. We've been doing that via ZB. If rates are going to go higher, then we want to stick with the short side. Now, the volatility we're going to see, you might say, Rog, now what? Don't worry about it. That's good. This is where the market's sorting out what it wants to do. This is actually, we get to talk about a lot of cool things in this session here. So you might say, okay, now what? Nothing. Okay, why? Why nothing, Rog? How do I know that? Or how do you know that? Why are we going to do nothing? Okay. Last week, if you remember, you can check out the recording from last week because we did that one live as well. Last week, you'll notice we went up, tagged the resistance, had clear bearish bias before NFP, waited for that particular setup. If we got that pitch, great. If we didn't, no problem. Today, neutral intraday sentiment from the European session on, but bearish on the equities in the sense that we were below the line in the sand. One of the cool things about, and this is called the HPMR, it's a time and volatility tool. I'm sure a lot of you are pretty well familiar with this because we've been using this in one form or other since 2013. First, it existed on a spreadsheet. Now we've got the cool zones on our Trading View and Thinkorswim charts. See how they've narrowed? Do you see how these two boxes have almost sandwiched? Sometimes they'll even crisscross. That tells you, keep away. The moment those two boxes start to come together, that is our visual reminder, stay away. Stay away. Why? Because we have now exceeded the normal historical volatility. It's a warning that we could go anywhere. We can go all over the place, but it's a warning that we've exceeded the historical volatility. So you might say, Rog, first the wick down. Now we're heading higher. Leave it be. Don't start getting tempted to do anything crazy, because a lot of times that all that price action becomes a temptation. Don't be tempted. That indicator is telling us, chill out. Here, take a look. This is a perfect example of, yes, we wanted to be short, did not get the intraday, but are getting wonderful follow through from the expectation of continuation. So this is really more a confirmation of two things. I'll show you the other chart that's been telling us, hey, gang, don't get too optimistic about the upside. But here we actually have that crisscross, right? So again, this is this tool telling us, hey, please don't go do anything crazy. This volatility is far beyond sort of the norm. Chill out, let this market settle down. So wouldn't it be nice to know when not to do anything? So today's a really neat example of some of those things. And we never know what we're going to get when we do these sessions. And I'm so glad I could show you some of these things. All right, the VIX, the daily VIX. This is a really interesting chart to me. And if you recall, not this past Tuesday, last Tuesday, so over a week ago, about 10 days ago, I did a video on stay short bonds. This is 10 days ago. Bonds have gone significantly lower since. Basically, I in that video outlined bonds are heading lower and the VIX is heading into a zone of support. Now, we were still above that zone, but we were heading down towards it. And I said, as long as we're heading down into that zone, we could see a little bit more chop or a little bit of more bullish hopium optimism in the meantime. But once we get down to the Darvis and the 200, that's where the real battle is going to happen between bulls and bears. And based on, take a look here, based on an oversold stochastic in a neutral environment reaching support, that's just a technical setup, gang. It's really an oversold bounce environment. There goes the VIX, there goes the market. So if you look at the levels on the VIX, and by the way, every one of these levels is automated, right? Here I've got my simpler propulsion. Here I've got the Darvis 2.0. By the way, both of those, the Darvis 2.0 and simpler propulsion, is available for free over at countdowntrader.com. When I say free, I don't think we even ask you for an email address. So head on over there. You can download the Think script. And if you're on other platforms, you can go through their built-in app. For example, on TradingView, you can just search Simpler and you'll get all the free tools that I do make available. So there's your confirmation of likely why this equity market sort of sideways action was likely to move lower. A, it's continuation on the broader, the daily trend. And B, that VIX was sitting at that level where we don't want to presume that it's going to go through. We want to presume, as it had before, in a neutral market, oversold stochastic, that we're going to bounce higher. So nothing really intraday, but excellent confirmation of what we've been talking about now for weeks, which is please don't get hoodwinked into thinking this is just a little rest area along the highway of heading north. No, gang, this was just a giant U-turn, because this is actually continuation of the previous trend. And that's just some technical analysis, or even some trend understanding 101. So nothing really in terms of the intraday, which is a bit of a bummer. Again, glad the line in the sand was pretty much telling us, please don't buy this market. Please don't front run what you think the CPI can be, because if anything, we are on the bearish side of psychology, not the bullish side. You can see that orange line. This line is right there. Please don't do that. So no short, but plenty of warnings to just sort of stay away at this point. The bell will ring in 45 minutes, which is indicative of what? Well, more. What does that tell us? It signals more attention, more volume, and the broader group of market participants. And likely they're going to echo, right? We have this echo effect we've talked about. We're going to see that 8:30 echo effect into 9:30, because there's a whole group of traders who aren't futures traders, who aren't Forex traders that say, hey, we get to finally, express our opinion about what we thought about that CPI number. I don't think they're going to be in a good mood about it. So we'll definitely keep an eye on that. All right. So as always, never know what these hot zone sessions are going to bring. But if you're enjoying these hot zone sessions, whether you're here with me live, I thank you. Or whether you're catching these on replay, again, I thank you for catching this on replay as well. Smash that thumbs up. Let us know that you want us to keep doing these hot zone sessions, and I'll pick a few every month. And maybe we'll keep up with this narrative, looking at time, looking at volatility, looking at the hot zones of these important macroeconomic releases during a time where the markets kind of want to challenge what the Federal Reserve is wanting to do. Remember, we don't want to play a game of chicken with the Federal Reserve. The bonds tried and they failed spectacularly. Equities were sort of waiting to see how the dust settled, and we're seeing how it's settling now in the direction of the previous trend. So, by the way, for those of you that have broader questions about the market, we're going to have our charts and coffee session in about 15 minutes at the top of the hour. So again, I thank you for buckling your seatbelt, putting on your helmets, and joining me for our high impact, high volatility scheduled event, otherwise known as Hot Zone Session. Thank you as always. I'll see you all at the top of the hour for charts and coffee. Whatever questions you might have, we'll go through those symbols then. Thanks so much, gang. This has been fun. I'm kind of bummed we didn't have a setup, but I'm really pleased that I could show you how important understanding the process of directional bias is. And if this is mildly entertaining or definitely something you want to learn more about, I mean, who's not entertained by a candle that's 3 inches long on your chart? My gosh. Head on over to simplertrading.com/price. We'll have a lot more examples. We'll get into a lot more in-depth conversation about time, volatility, trading the edges. How do you define them? And how I've been day trading through 2022. All right. That's next Thursday, 8 p.m., simplertrading.com/price. Because apparently, and we know this, only price pays. How do we find those levels? All right, gang. I'll see you at Charts and Coffee.